Hello, everyone. Thank you for joining today's web conference, the CNR April 2024 Market Update. My name is Elizabeth Dooley, and I'm a Senior Portfolio Manager here at City National Rockdale. I will be moderating today's presentation. I'm joined by several key leaders from our investment strategy team, including Chief Investment Officer Charles Luke, Senior Economist and Portfolio Manager Paul Single, and Head of Fixed Income Mike Taila. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, our presenters will share their perspective on the shifting market sentiment and implications for client portfolios in 2024. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download today's presentation materials using the resources window on the right-hand side of your console. With that, let me congratulate and now turn over to our newly appointed Chief Investment Officer, Charles Luke.
Thanks, Elizabeth, and welcome everybody. It's certainly an interesting day in the market, so it's good to be with you. I wanted to start with a little bit of our investment strategy committee highlights and just go through what we're seeing on the economic side, and also just how we might be adjusting strategy in the areas that we like. So just to kick it off, our probability of a soft landing or a slow growth environment that's avoiding a recession has risen to about 70%, which is pretty normal in any environment. If you look at inflation, consumer spending, GDP, and a variety of other indicators, they've all shown a lot of strength. And so what we think is a higher for longer environment, that's one we're going to have structurally higher interest rates. We do expect to see a lot of volatility in the data. And so that means we're going to see overshoots and undershoots this year, all throughout the year. But we think that it's probable that strength's going to outweigh weakness in this environment. And if you look at the consistently strong data, what it underscores is our call for inflation to be sticky, and it has provided a positive backdrop for equities and risk markets. But that's balanced against geopolitical risk and the elections that we have later this year and the potential for the Fed to be on hold a little bit longer than we expected. And so there's no shortage of short-term risk, but we don't see any of these items derailing long-term returns. And strategically, we are staying focused on US markets for several reasons, and I'll get into those in my comments on the equity market. And while we have been reducing our exposures to defensive sectors throughout the year so far, and those we mean are industries that tend to perform better when the market does drop, we do remain more conservative overall within our equity portfolios, and that's been very helpful for us as the market's retreated from its highs, especially on days like today. I also believe the escalation that we saw last week in the Middle East was a good litmus test for how the market may react to similar events as we go forward. And it was interesting to see some of that selling pressure mount, followed by this week where we have a lot of data around earnings and fundamentals. And so before declining today, the market had been moving higher. And that's a small example of how risk that's unrelated to the US economic environment can create a lot of concern, only to be overtaken by the core fundamentals that are driving the market. And the last comment just on our investment strategy is that we continue to like bonds. We suggest that our clients do think about buying some longer term maturities. Yields here look high to us relative to what we see as fair value. And we don't think that we're going to get a 10-year US Treasury below 4% this year, but we do see this as an opportunity to lock in some income with less risk, and that's going to set our portfolios up well if the economy does slow a little bit more than we expect. And so shifting into our economic forecasts, our investment strategy committee has finalized the estimates for 2025, and they do reflect a gradual continuing trend, a little bit of a slowdown in growth. And so if we look at also the 2025 estimates here, we have lower expected inflation, and we're seeing a normalization of Fed policy. But it's important to talk about 2024 because a lot of the recent strength has led to a few adjustments for us. We have taken up the lower end of our inflation numbers. We don't believe it's likely the Fed's going to reach that 2% inflation target this year. And we do believe there's going to be a lot of noise in the headline numbers, which include energy and food prices. So we're going to see a lot of volatility there. But if we look at core inflation, and that's mostly comprised of services, which I'm sure Paul's going to talk a lot about today with the GDP release, we think those are going to be a little bit more stable. And we don't think they're going to come down by much. We also think the Fed's going to need to see a lot more data before they're comfortable cutting interest rates. And it's not our base case, but we do think there's an increased chance that the Fed may not be able to cut rates on some concerns that continued growth may push inflation higher. And we thought the market was ahead of itself back in December and January with 7 rate cuts projected, but we kind of think it's equally improbable here that the Fed's going to be in a position to raise rates again. And so from a high level, inflation's down about 5% from its peak. I mean, it was at 8%. And so the Fed certainly doesn't want another flare up, but it does make sense to get a lot more data here before we can definitively say that policy rates just aren't high enough. So we just simply don't think it's likely the Fed's going to increase rates in 2024. And so 2025 is still a way out, but we do see positive growth, and that's going to be driven by high expected earnings. And we do think yields are going to stay above about a 4% level as the Fed does begin to cut interest rates. And so moving on to our speedometers, we made a few adjustments here in March as economic growth improved. And so you can see that reflected in the green speedometers with consumer sentiment, with jobs, housing, and earnings all looking very strong to us about 6 months out. And the only adjustment that we've made in April is to our international economic outlook dial. And we bumped that up. The IMF came out with better forecasts last week for global growth. They came in at about 3.2% for 2024. And that's a little bit above the previous forecast. And so if you look globally, we still do have this inflation trend that's falling. We have looser fiscal policy and cheaper international currencies, which are boosting exports in a lot of the emerging market countries. And this is balanced against a backdrop in the Chinese economy that continues to be challenging, and it's still severely impacted by a wipeout in the property markets there. So we believe in the US growth engine, and we continue to avoid international markets in the equity portfolios. But I do want to underscore that there has been an opportunity in fixed income with emerging market US dollar debt. So that's emerging market countries and companies that are issuing in US dollars. And that's helped boost returns in our high yield bond portfolios. And we've had a lot of continued strength in some of the floating rate positions that we have, and that's in leveraged lending and private credit, which we've all been hearing a lot about. So overall, relative to our speedometers and outlook, we do see a lot of runway for the economy here. But even though the economic picture is strong, if we think about the interplay of global conflicts and looking at the West's continued support that we've seen with the passing of the Ukraine, Israel, and Taiwan aid bill this week, we're going to continue to feel some of these spillover effects. And we also think that a lot of the rhetoric from both political parties on tariffs could lead us to trade tensions and potentially affect the economy. And so when we're thinking about the Middle East, Russia and Ukraine, and China, Taiwan, to us, the biggest potential long-term impact on the US market could come from China and US relations in terms of trade. And so right now, we think the market position and the economic strength is with the US. And while China continues to sort through their property downturn, that's going to continue to be an advantage. The US is also benefiting from deglobalization right now, with exports picking up to Europe, and that's replacing a lot of the energy demand that was lost and supplied by Russia. So right now, the stability of the dollar and the position of US markets is going to keep capital flow high, and it'll limit the impact of trade tensions right now, but it's going to become a bigger issue as we move through 2024. And another economic area that we're seeing a little bit of an impact is coming from commodities in the precious metals market. If you look at crude oil, that's up about 22% this year. Gasoline has risen about 16%, and precious metals right now are on a run. And that does reflect a lot of the dynamics of a strengthening dollar and concerns over inflation rearing its head again in this market. But overall, just like we saw with the invasion of Ukraine, markets tend to focus on the fundamentals going forward after we see an initial selling period. So we do think that we're well positioned for a potential correction, and we view any large drops here as an opportunity to increase our equity exposure. In taking a historical view, if you look at the average S&P 500 return without a recession, and this is especially after major military conflicts, it's positive over 1 month, 3 month, and 1 year periods. So if you look at this chart on the right-hand side, you can see all of those going back to 1973. And so what that says to us is that the market does key off the fundamentals. And so we can't ignore the elevated anxiety over what's happening out there globally, but we do think that a sustained sell-off in stocks is much more likely to be caused by a US domestic economic problem than it would be by an international war. And as I mentioned prior, if you look at the US right now, it is a beneficiary of deglobalization with a stronger dollar. We have stable markets here and higher growth rates than the rest of the developed world. So we don't believe that's going to change anytime soon. And the other elephant in the room to talk about is what's happening with the election. So we can take a look at the election cycle in the year of the presidential elections all the way through year 4 after the transition happens, in the same lens that we looked at a lot of the military conflicts since 1973. And so as investors, we're focused on the market outcome, not the political one. But if you take a look at these charts, we know that regardless of the cycle and regardless of political party control, that most data points on returns tend to be positive, even after major elections. So that doesn't mean volatility won't exist. And I think back to 2016 with the Trump election and all of the volatility that we saw there. But it does mean that drops in the market could present opportunities for investors. And what the data shows here is that we take a look at drawdowns, they certainly could happen, but only 5 of the past 24 election years have experienced negative returns. And on average, the market advances about 7.5%. And that is consistent with our return estimates for this year. So when we bring all of this together and think about the impact to the markets, for us, the core factors that we need to be paying attention to boil down to inflation, interest rates, the geopolitics, and the US election cycle. So each factor has an influence on the other one. And we do believe this will continue to create a volatile environment, but the fundamentals are likely to remain strong. So we could be overwhelmed at times at brief moments like we were last week by any one of these factors or any combination of these factors, but we don't see it impacting the longer term return picture. So I'm going to stop there and hand it off to Paul for the economic update.
Great. Thanks so much, Charles. And Charles is right. The fundamentals are extremely strong. And even with today's number for the GDP report, it was a shocker. It came in at 1.6% for the first quarter. The expectations were for almost a full percentage point higher, around 2.5%. But that's a bit deceptive, the 1.6%, because most of that reduced growth that we saw in the quarter was because of net trade, inventories, and the inflation picture. If you take a look at the chart on the left-hand side, it's measuring GDP. The column is the quarterly change, which is annualized, and then the line is the year-over-year number. As you can see, the first quarter's growth at 1.6% is the smallest we've seen since the first half of 2022, when we registered 2 negative quarterly numbers. Those numbers were negative because in the first quarter, it was net trade that forced that into the negative territory. That's when all those container ships sitting off Los Angeles got unloaded, and that pushed that number down. The second quarter was because of an inventory adjustment. Well, same sort of thing is happening this time around. If you look over on the right-hand side, this is showing the contribution to GDP of the 4 major categories. The way to read this chart is the dark blue column is what happened in the first quarter. The light blue is what happened in the fourth quarter of last year, so you can make a comparison. And then the gray is the year-over-year change, so you can get an idea of what the trend looks like. The most obvious that you see over on the right-hand side is the net trade number. We just imported far more than we exported. The reason for that is that the U.S. economy is extremely strong. We can't make enough products here in the United States, so we imported an awful lot. It took 0.9 of a percentage point off the GDP number. That's a big amount for that part of GDP. If that was neutral, the GDP number would have been 2.5%. So that was the major cause of it. The inventories, they rose a little bit, but the way the inventory number is calculated in GDP is if it didn't rise more than the previous quarter, that's considered a negative. And then the inflation part, that one is a bit tricky and problematic for the Fed. We knew inflation was extremely high in the first quarter of this year. That's no surprise. It was just a little bit higher than expected. It came in at an annual rate of 3.7%. So as Charles was saying, that may delay when the Fed is able to cut interest rates because they're going to want to see some good numbers coming in the next few months before they make any decision to lower interest rates going forward. But the underlying issue is that the economy is doing quite well, mainly driven by the consumer. There's a number that economists pay attention to. It's called the real final sales, and it's GDP, but they take away net trade, they take away inventories, and they take away government spending. And when you do that, you're looking at the true fundamental growth of the U.S. consumer, which was up quite a bit this past quarter at 3.1%. It's been above it's been at 3% or higher for the last 3 quarters. So the underlying fundamentals of the economy, as Charles said earlier, is quite strong. In terms of taking a look at the growth, the left-hand side, this chart here is just measuring GDP growth in terms of the dollar terms. The 5-year trend that was established before the pandemic, you can see as the dotted line. The economy dropped 9.1 percentage points during the recession. It had to make that up. And you can see we're pretty close to being back on trend. And that's quite remarkable because that decline in GDP was the biggest that we ever saw since the Great Depression. In terms of how we stand versus the rest of the world, that's an important issue to keep in the back of your mind. Now, the economy is doing well. Americans' perception of the economy is not as good. But be thankful you're here in the United States, where you can see that the growth has been much greater than that of what we've seen compared to most of our trading partners. The UK has barely made it out of the pre-pandemic peak of what they had. But right now, they're in a recession. Growth for the last few quarters has been very, very low, and that's put them into a recession. In Europe, their growth in the last year is just 0.1%. Japan is at 1.2%. China a little bit stronger, but they have a whole host of problems that they're dealing with that are big macroeconomic issues. And the main reason why we've had such strong growth is really as a result of labor growth. The chart here on the left-hand side just shows the cumulative change in payroll growth since the pandemic. We've added almost 6 million new jobs. That means more income coming into households, which gives them more money to spend. If you take a look at a breakdown of where the people have been hired, you can see that on the right-hand side. That's measuring the percent change. And most of the jobs where we're seeing the bigger growth is coming in areas where have higher pay. So that gives them more disposable income and the ability to go out and spend more money, again, to drive economic growth. And this has been remarkable. We've seen some changes going on here because of the pandemic and because of businesses allowing people to work at home part of the day or a few days each week. That's allowing more women to come back into the workforce, either working part-time or full-time, and still be able to manage children at home. Men are also starting to increase in terms of the growth, which is also a bit of a change from what we have seen in the post-pandemic period. But the biggest issue is foreign workers that are coming back or that are coming into the workforce. And this has been an important driver because in the United States, we're dealing with the demographics of the fact that baby boomers are retiring at a faster pace than the younger generation is coming into the workforce. And immigration had worked through the backlog of visas as a result of the slowdown during the pandemic, and that's allowing them to push more people into the workforce, and they're able to work more. On the left-hand side, you can see the light blue area. That's the amount of foreign-born workers in the United States since 2000, and it represents about 1 in 5 workers. On the right-hand side, it shows what the hiring has been since the beginning of 2022. And again, the light blue is showing what foreign-born workers. And it's about 3 in 5 workers that are being hired to help drive economic growth. And by having that more supply, it has helped reduce the pace of wage gains that have been going on in the market for the last few years that have been higher than what the Fed wants to see. But the biggest issue is the fact that people are being paid extremely well. They're being paid better than inflation, and they're spending their money. In this chart here, the shaded area is the personal income number. And as you can see, over time, that has been increasing at a pretty strong pace. The 3 spikes that you see there, that of course is when checks were mailed out to people during the pandemic area. But the blue lines, the light blue line is CPI, the dark blue line is core PCE. So whatever number you like to follow in terms of inflation, you can see that that inflation rate is below what people are earning. And as a result, the gray line that's above it all is what people have been spending because they saved an awful lot of money during the pandemic, and that's giving them quite a bit of money to go out and spend and drive economic growth. So financially, although inflation is high and people complain about inflation, financially, people are much better off in terms of dealing with the higher inflation than they were before the pandemic. And you can see that here on the left-hand side in terms of what's causing inflation to be a bit of a problem. On the left-hand side is CPI broken into the 2 major categories. It's goods, which is in the dark blue, and services, which are in the light blue. Goods prices have pretty much reverted back to what we saw before the pandemic, where it's pretty close to around zero. But it's the service part that's very high, and this is what the Fed is dealing with and tackling in terms of trying to reduce inflation. On the right-hand side is a breakdown of the major components within CPI. Again, light blue is services, dark blue is goods, and you can see the averages in the dark gray. But it's the services that's driving it, and it's really shelter costs that is the major cause of inflationary pressures for the Fed, and that's what's keeping inflation high. But in terms of what consumers look at and what they think of is the biggest issue, and this is the frustration that many consumers have in terms of pricing and how it's different than the market's view of inflation. The market view, when they look at inflation, they look at the year-over-year percentage change. People, they tend to look at price now versus what it was beforehand. You know, I'm paying now this amount for milk. I used to pay something less. I'm paying more for eggs, and so on and so forth. And so you can see that. On the left-hand side is food on a year-over-year basis. Food prices have come down remarkably since a very high level. But again, people are comparing what the price is in terms of absolute basis versus what it was beforehand, and that's the frustration. They're not paying attention to the fact that they're a whole lot wealthier. That side of the balance sheet's doing well, but it's the expenditure part that they worry about. In the middle, you can see gasoline prices that are now eking a little bit above what they were before the war started. But on the right-hand side, these are household expenses. And this is another thing that people tend to focus on much more than any other inflation. And here again, you can see it's much higher than the average inflation rate. In terms of the Fed, this is the remarkable part in terms of what we've seen in terms of monetary policy. This chart here, the dark blue columns are showing the change in interest rate that we've seen since 1970 in terms of the change in the interest rate of the federal funds rate. As you can see over on the right-hand side, it's one of the higher levels. It's not as high as what we saw on the very far left, but keep in mind, on the very far left in the 70s and 80s, interest rates were a whole lot higher, so you needed a bigger move to make an impact on consumer spending. And also, remember, that's when the Fed was trying to cause a recession. That's not what the Fed wants this time around. So if you look at the more recent history, you can see that the change in interest rates is among the highest. But more impressive is how long they've kept interest rates at the high level. Again, you can see that it's the second highest of what we've had. So the Fed has a very hawkish stance in terms of monetary policy. It's just taking time this time around before it's having an impact on the economy. And that's mainly because households are in such great financial shape. So with that, let me turn it over to Mike.
Great, thank you, Paul. And hello, everyone. So today I'll be covering the fixed income markets, and I'll start with a recap of recent events in the market. I'll touch on the underlying fundamentals, and then I'll discuss what we're seeing, where we're seeing opportunities today. So if we look at this first slide, we show how yields across the Treasury curve have changed so far this year. But the story really needs to begin with a look back to the fourth quarter of last year, where, if you recall, by September, there was really no indication from the Fed that they were ready to start cutting rates. And we had this significant pickup in supply around the debt ceiling fight. And as a result of this, the 10-year hit a high of 5% in October. And then once that messaging from the Fed shifted, this kicked off this broad rally in the markets, and the 10-year dipped below 3.8% to close out the year. Now, this year, you can see on this chart, we've had this steady climb in rates across the curve. And the 10-year yield is pushing on 470 this morning. We can attribute this move to the strength in the underlying economy, and the inflation concerns, as both Paul and Charles have discussed. But more importantly, what we're seeing is this shift in expectations for the Fed, where the market has gone from pricing in 7 cuts this year at the start of the year to about 1 today. And with that, the curve has shifted anywhere from 80 to 90 basis points higher in response. So as we look at rates, the curve is effectively back to where it was at the end of September of last year. And this is consistent with our expectations for continuing volatility, for rates to remain higher for longer, and for the 10-year to be range bound somewhere between 4 to 4.5%. So as we navigate this recent volatility, we have been mindful of the pressures on the market that could challenge yields. On the one hand, we have the strong demand due to the attractiveness of the yield environment that we're in today. or even the safe haven nature of the asset class. And both of these support the market. But we also have some challenges, such as what we show on this page, which is this large pickup in Treasury issuance that's primarily due to the large federal budget deficits. So this week alone, for example, we had $180 billion in new debt across the 2-year, 5-year, and 7-year maturities. While the 2 and 5-year, these auctions have been well received, supply, especially further out the curve, it could weigh on the market as we get deeper into the year. But then we also have to remember that the Fed is at play here as well. So with the balance sheet down by about $1.5 trillion since the beginning of them letting the roll-off begin in the summer of 2022, there is talk that they will begin to slow this process. And really what that means is that the Fed would return to the market as a buyer, and this is going to help support any supply or demand mismatch that we see. Now, on this next slide, we're turning our attention to credit fundamentals. And here we are looking at the high yield and the investment grade corporate bond markets. And really the primary takeaway here is that the overall credit fundamentals are quite strong. So looking at the chart on the left, we show interest coverage ratios in the high yield market. And we break this down by looking at the broad index and then various rating segments, looking back to 2001, 2015, and then the yellow bars on this chart represent last year. And what we see is that interest coverage ratios or really that ability to pay interest expense it's historically high, even when you take into account the higher interest rates that we're seeing today, as well as debt levels. And so one of the reasons for this is that issuers, they took advantage of the low rates prior to the rate hike cycle to term out their capital structures at these very attractive yields. And while we do expect these ratios to normalize as maturities are rolled into new debt, this is going to take some time. And then if we look to the right, it's a similar story within the investment grade space. So here we see that margins are pushing higher than they have been historically. So in addition to reducing the cost of capital, issuers here have been able to push through higher cost and grow margins over time. So whether we're looking at interest coverage on high yield bonds or margins on investment grade bonds, higher is better here, and it's really a positive story for the credit environment. In the municipal market, we're also seeing signs of strong credit fundamentals due to the strength of the economy. So the chart on the left shows the upgrade downgrade ratio for rated bonds within the Moody's universe. And what we see here is that for every downgrade, there have been nearly 4 upgrades. This is the highest it's been in over 15 years, and it has touched just about every sector of the market. So at the state and local level, budgets continue to be well supported by economic growth. And as you can see on the chart on the right, every state remains above investment grade. And this really speaks to the high quality nature of the asset class. Now, if we transition to the high yield markets, so the strong fundamentals we spoke about in the corporate bond market are reflected on the charts on this page. So the graph on the left, it represents the spread or that excess yield over treasuries in the high yield segment of the market. And what we see here is that the most recent spreads, they peaked at over 10% during the pandemic. We've been as low as 268, and now we're just over 3%. So trending below the 5-year average. But what's interesting here is that if we look back pre-2008, and this isn't on this page, but if we look back to prior to 2008, when the broad market rates were at comparable levels that we're seeing today, spreads were at roughly 3%. So very much in line with what we're seeing in the market today. In the table on the right, it shows distress within the market. And overall, we see that it's quite low, and it's confined to 4 segments of the market that typically have the most debt outstanding and are first to exhibit weakness in a downturn. So while we might have seen a little bit of an uptick in distress recently, we don't see this as indicative of a significant downturn in credit conditions. And if we look at nominal yields in the high yield space, north of 8%, and with strong credit fundamentals, we continue to believe that this is an attractive return opportunity. Looking at the muni market, here again, it's a similar pattern of tight spreads and strong credit fundamentals. So the chart on the left, it shows the yield difference between the high yield and investment grade segments of the muni market. And we can see that high yield offers 190 basis points of yield over the high grade. And once again, we're off of those highs that we saw during the pandemic, and we are trending below long-term averages. However, if we look at the chart on the right, this shows the historical incidences of defaults within the municipal space. And what we see is that a market with over 50,000 issuers, defaults are actually quite low. So we experienced a peak during the financial crisis. We had a small uptick during the pandemic. And now we see this light blue bar. We do expect to see some signs of stress in the market, but a lot like that corporate market, this is going to be confined to a few sectors. Most likely senior living facilities, where recoveries have been a lot slower since the pandemic. But again, when we look at yields in the high yield municipal market, they're over 5.5% today. And for an investor in a high tax bracket, this translates to almost a 9.5% taxable equivalent yield. So once again, it provides a compelling return opportunity. Now, if we take a look at the technicals that we're seeing in the market, and the chart on this page is really one way that we look at broad interest in the bond market. And this shows the net weekly flows, the money coming into and out of bond mutual funds. And this includes all segments of the markets. It's treasuries, it's corporates, it's munis, it's high yield. And what you can see here is that we've had this historic period of net outflows during 2022. But more recently, right, since the beginning of this year, since 2024, and despite this rising yield environment where we've seen rates up anywhere from 80 to 90 basis points since the start of the year, investors are really starting to feel better about bonds. Right? They're more comfortable with the volatility, and they're finding higher yields. They're finding value in the higher yields that we're seeing in the market today. And so if we bring this all together, we have short treasuries that are yielding over 5%. Corporates are pushing close to 6%. Munis on a tax-adjusted basis north of 6%. And then we have the high yield markets in the high single digits. While the markets are likely to remain volatile, and we're seeing that play out today, we continue to find it an attractive opportunity. The higher yields that we're experiencing today, they provide a cushion against this volatility should rates continue to move higher. And should we see a drop in rates, we have the potential to see very attractive total return opportunities when you combine that yield with price appreciation. So I think with that, I'll turn it back to Charles. Thank you.
Great, thanks, Mike, and thanks, Paul, for the economic update as well. So if we move forward and turn our attention to the equity markets, what we're seeing, if we look at the past 5 months, is a run-up of about 25% when we compare it to historical periods of 5 months. So it's one of the only 7 times in history that we've seen the market climb more than 25% over that same period. So what we can learn about that in that context is that after about 1 month of reaching that 25% mark, returns over 1 month are mixed. So we have some that are up, we have some that are down. So we're not surprised to see the market drop that occurred last week, and we'll see what happens when the week gets out here. But we're not surprised to see that drop from all-time highs that we hit in March. And if we think about this week specifically, it has really been critical in determining a direction for the market, especially for the rest of the year. And as Paul noted, we still see underlying strength in the growth numbers. So there's not enough to suggest to us that a sustained drop in prices is going to occur. But what's really telling about this data is when we look at the 12-month return, so if you look at that right-hand table right there, on average, the market rises about 19%. So again, just to summarize, over 5-month periods, we've had 7 times in history where the market's been up 25%. And about 12 months after that point, the market still rises over 19% on average. So we do think we're on firm ground, anticipating sustained economic growth. And you certainly can make an argument that the market's expensive here, but we still think it has some room to move higher as we move forward. And moving along just to what we're seeing in terms of market leadership, our optimism here is tempered a little bit by what we're just seeing in the composition. So we all know that the Magnificent Seven has powered the S&P 500 forward to new highs. If you look at the left-hand side here, the 2023 returns were simply amazing, but 2024 is telling a little bit of a different story. So when you hear the Magnificent Seven go into the Magnificent Five in the Wall Street Journal, we should probably take notice of that. So leadership is breaking down a little bit. And if you think about the earnings report from Meta yesterday, we did see them increase their CapEx spend, which analysts were certainly negative on. And that is a powerful contributor to return in terms of what's driving the contributions to the S&P 500. So for the market to really keep moving here, we're going to need a broadening in participation. And we do think there are areas of the market with long-term underperformance. If you look at small and mid-cap stocks and other areas that are trading at lower valuations that are positioned to move higher and can still be defensive if the market does move lower. So this does also highlight a lot of the risk in the market for a potential correction when leadership is thin. So if we see a stumble from any one of these major tech names, it could significantly impact market sentiment. But we do think if that does happen, it's a buying opportunity for us over the year. And turning our attention to the global picture, certainly this is something that we discuss a lot, but we're standing firm on our call to avoid international equity markets and to stay in the US. And as I mentioned earlier in my opening comments, the economy so far has been a beneficiary of the deglobalization trend, there's no doubt. So the US economy's growth relative to the rest of the developed world continues to show separation. So if you look at that left-hand side here, we're advancing at a much quicker rate than other developed markets. But instead of saying that we're just investing in the US here and we're going to keep it that way, I think it's important to talk about some of the conditions that are going to be necessary for us to invest internationally. So the first thing that we're looking for when we kind of set up the relative comparison are catalysts that can shift the growth pattern and lead to structural advantages between economies. And we've seen plenty of temporary blips in growth, especially coming out of the pandemic and especially related to reopening, but it just hasn't lasted internationally. And second, we need a stable currency. So I think this is a point that a lot of investors are missing this year. If we take Japan, for instance, if you're a yen investor, so you're investing in Japanese yen domestically, you're up about 14% this year, which is a great return. But in dollar terms, because of the strength of the dollar, you are underperforming the S&P 500. So we need that currency to be stable and a good outlook moving forward. And then the third thing that we need is the international picture to simply be more stable. So we think about responses to these geopolitical threats. If we look at the divergence that can happen in economies, that can certainly impact returns negative. So we'd like to get to a more stable point before we're ready to jump into international markets. And so I know there will be a time when we're ready to invest internationally and we see good opportunities, but we simply need a better, more durable backdrop in order for that decision to meaningfully add to return to portfolios. And so I'll just end that with looking at the right-hand side. You know, historically, the US markets have had a major return advantage, and we're looking for those three things before we're ready to move out. And I also wanted to address equity income, and we've been encouraged to see some of the outperformance in the market pullback related to dividend and value stocks. And I think if we look at many clients, you know, we've been taking the opportunity, just given some of that small outperformance, to reposition into our core equity strategy and take advantage of a lot of the growth and tailwinds to the market that we see from the economy. And I also want to note here that if you look at valuations, certainly there's a wide gap. And it's significant relative to the S&P 500. But I want to stress that valuations alone, without considering other factors in the market, just aren't enough to form an investment case for us. So we also think these valuation gaps can exist for long periods of time, and certainly timing a reversal is very tricky. Where we do like the equity income strategy and portfolios is for our clients who have a need for income, but they want to maintain that exposure to equities for a growth component in their portfolios. And so dividend stocks can be powerful in an asset allocation there, especially with dividends growing. So I can show you in the right-hand side here, they grow about 7% over time, and they certainly can help to preserve capital, beating inflation rates over the long term. And we also talk a lot about quality in our portfolios. So I thought it would be good here to do a little bit of a deeper dive into exactly what we mean. So what I did here was break down different components that we use to arrive at our quality rankings. And so you can see across the board that our companies are positioned with better long-term metrics relative to the market. We do believe this gives us an advantage over longer time periods. And I mentioned earlier that we've been slowly ratcheting down that defensive posture that we had in 2023, but that overall we're still tilted defensive. So we feel like we're in a good position to weather a correction. And if there's enough of an opportunity, we will be willing buyers. But we still think there's a long way to go until we're on solid ground to make that decision. So in summary here, we seek to own quality franchises with competitive market position and long-term growth prospects. And certainly quality is just one of the factors that we use in making that decision, but it's a very important one to our overall framework. I also wanted to spend some time today talking about the components of inflation, interest rates, and valuation, and sort of tying them together. So if we take a look at this page, let's just start with rates and inflation. I can honestly say here that we've been observing an abnormal relationship in the market between interest rates and inflation. And if you look at all the observations, those are identified in the light blue in 2022 and 2023. We've sort of been off of this expected relationship. We've been below that yellow line that represents it. And you can argue that there are reasons for that. So Fed balance sheet growth, long-term demographics, globalization, and similar trends that we've seen over the long term. But we've held that rates were probably too low. So they should move higher, especially given this relationship. And so with the recent rise that we've seen here, again, north of about 4.7% today, and we tested that 5% level last year in October, that 5% is definitely within our reach now, especially with the GDP number and the reaction from the market that we're seeing. So we do think that it's likely we'll probably retest that 5% level again, which would be more on trend. And so if we follow through to rates and the impact on valuations, what you can see here is that we've had two regimes represented on this chart. So you really break it down between an environment with yields above 8% and an environment with yields below 5%. And so if we just take what's on the chart alone and don't consider those two different regimes, valuations do look pretty elevated. And we would agree with that just based on that data. But if you think about a 5% 10-year, it's still low relative to the context of history, right? You can see all those data points that are beyond 8%. So we think that we should expect some pressure on valuations as interest rates do increase, but we believe in the strength of this market and the potential for high earnings we think overwhelms interest rate increases here. So if we see any pullback that we think could be initiated by interest rates climbing higher, and we could be in the beginning stages of that now, we think it's just an adjustment to these higher rate levels, but we don't think the valuations here have material room to fall and certainly don't need to fall substantially to make the market attractive to us. I wanted to take a moment as well to talk about earnings because we're in a situation where projected earnings towards the end of this year are very high, as well as in 2025. And so that's been driven by loosening financial conditions as the Fed gets closer to potentially cutting interest rates. We've had really strong consumer spending and also hiring. And so we think that's going to continue to drive company prospects as we move forward. And then certainly we have the components of artificial intelligence and technology that are adding to that as well. And if we look at earnings this week, we have about 35% of the S&P 500 reporting, and about 81.5% of those have come in with positive surprises so far. So even with some of the big headline news, again, on some misses like with Meta last night, it underscores certainly how fragile the market can be with such thin leadership, but we still have the broad market coming in ahead of estimates. And prospects continue to be positive for this year. So we're certainly slightly lower than consensus in 2024, but I do believe the fundamentals here will ultimately support stock prices. And then if we look at 2025, we're a little less optimistic than the broader market, and that consensus right now is about 13.8%. And one of the biggest factors is that we do see headwinds from a stronger dollar, really taking a bite potentially out of U.S. multinational companies when they bring earnings back to the U.S. So that's going to be something that we could see arise a little bit later this year and then into 2025. But ultimately, we see the earnings picture as a very good one, and we think that's supportive of the equity market moving forward. And so the last component that I want to leave everyone with is really what happens in the stock market when the Fed cuts interest rates. And so we've had, if we look back over history, and this is to 1984, there have been 4 times that the Fed has normalized policy. And normalizing policy is different than having to cut for recessionary concerns or an emergency situation like we saw in 2008 or what we saw in 2020 with the pandemic. So if we take a close look at this, if we're normalizing, and let's say the Fed cuts rates by 1 or 2 times, we still see very positive returns. And those returns are pretty consistent with what we expect from our assumptions when we entered this year. So in 1984, 1989, 95, and 2019, we've seen high single-digit returns on average. So we think if the market kind of goes through the year with the strong underlying fundamentals, the growth prospects that we have, and the Fed is looking simply to normalize policy to get ahead of what could be a bigger slowdown, that can set a positive backdrop for the economy, and we think that'll drive stocks higher. So I'm going to stop here and I'll hand it back to Elizabeth.
Thank you, Charles. And we thought we would end with a familiar slide, which really talks about volatility and looking at the market and volatility and market returns over the long term. And I think really the main takeaway here is that, as Paul mentioned, the economic story is pretty solid. And as Charles just went over, the earnings story, even taking some weakness in some of the key names into consideration, is actually pretty solid. So we come back to uncertainty will create volatility in the market, but we're in quality companies, and we do believe over the long term, those companies will continue to grow, will continue to generate profits. And dealing with volatility and heightened volatility is really par for the course for us as investors. So now I wanted to turn it over for questions. And a quick reminder before we start, if you want to submit a question, you can submit it into the Q&A console. And it looks like we actually have quite a few to get started with. Paul, we're going to start with you. And based on today's GDP number, should investors be concerned about stagflation, or do we still think that a soft landing is the more likely outcome?
Yeah, stagflation is one of those buzzwords that does tend to get people to click on that article and want to read it. I know I read a few this morning. Stagflation assumes two things. One, stagnant economic growth, and two is high inflation. In terms of economic growth, it's not at all stagnant. As Charles mentioned early on, a lot of spending in the first quarter on services. I mean, total consumption was up 2.5%, which is a good, solid growth rate. It was driven heavily by spending on services, which were up 4% on the quarter. To put in perspective, 4% growth, we've only, outside of the post-pandemic jump in spending, but since 2000, we've only seen that pace of growth 3 times since 2000. So it's very, very strong. And keep in mind, Taylor Swift's not touring in the United States. So people are finding ways to spend money. And that's really driven by the fact that we have very strong labor growth. Non-farm payrolls picked up in the first quarter compared to the fourth quarter of last year. It averaged 276,000 new jobs. Anything above 100,000 is additive to the economy. So even if we get slower pace of hiring over the next few quarters, it's still going to be driving economic growth. So we're not worried about that. And again, the real final sales number, when you take away trade, inventories, and government, at 3.1%, that's very, very strong. So we know that the economy is doing well. On the inflation aspect, it's on a downward trend. It's not as swift as what we've seen in the past year, which was driven heavily by the fixing of a lot of the transportation logistics that caused an awful lot of bottlenecks. Now we're just relying on a slower pace of growth, and it's difficult. In the chart earlier, I didn't go into detail about it, but the leaderboard in terms of what's causing inflation to be a problem are areas that probably won't drop quickly if we have a healthy economy. It was transportation services, so that's like leasing a car or maintenance on a car, and that continues to be relatively high. It's household operations, it's bills that you have for water, sewer, and trash, and recreational services. That's your country club, that's your YMCA. All of these are things that people are willing to pay for as long as the economy is doing well. So that's the part that's problematic for the Fed. So inflation, we still think is going to continue to decline, clearly not as fast as what we've seen in the past year, and it is going to be a volatile movement. We're going to see a lot of ups and downs, but the long-term trend we expect to see a slower pace of inflation. So stagflation is not something that we see at all in the horizon for the U.S. economy.
Thank you, Paul. Charles, the next question is for you, and it relates to, as you mentioned, geopolitical risks are taking on increased importance. Can you touch a little bit more on the recent increase in commodity prices, and then what the implications are for our portfolio position?
Sure. Yeah. And I think if we back up and look at commodity prices in the context of global trade, that's really driving a lot of the increase that we've seen, because we've had a lot of situations in the Red Sea. I mentioned what's going on in the South China Sea. I've also mentioned all the geopolitical events that we're seeing from a military perspective. And so we're mostly concerned with that impacting inflation. And the other component here is just what's happening with the interplay on currencies. So a lot of what we've seen in precious metals, specifically gold, you've got a lot of buying from central banks, especially from China. And what they're trying to do with that is limit the impact on those currencies from what we've seen as a rising dollar, which is now up about 11% since the end of last year. But the real double-edged sword with commodities is that it's incredibly volatile, right? So just like we've seen these run-ups, if you step back and look at what the Fed's going to do, as we get closer to the potential to cut interest rates, that could result in a stark shift the other way. So I mentioned all the volatility that we could see in the statistics and all of the data going forward in 2024. So, we're not ready to make a call on investing in commodities, just given that historical level of volatility. We prefer to take that in the public markets with some of the opportunities that we're seeing right now. If we talk about investment positioning and how to defend against that, the focus has to turn back to prices and inflation. Right? So I mentioned the way that we think about quality in our equity portfolios, but we do need those quality names, durable franchises with growth rates that are exceeding the level of inflation. That's really going to be the best place to be. And it's going to just drive off long-term US ingenuity. And we also think you can get more return and more effective defense now than ever in the fixed income markets. So at these level of yields, I saw a question come in just sort of asking about the mix, but regardless of where you are, you can see a 5.4% 3-month or 6-month treasury bill all the way out to an 8% fixed rate high yield bond, and then other opportunities that we see in alternatives and private credit. So I think the backdrop gives us plenty of defense to be able to position portfolios against this rise in commodities that may filter through to the inflation picture. But ultimately, the volatility and what we have to take to be in that market just doesn't fit with a lot of the mandates we have in our portfolios.
And you talked about the de-globalization trend and the strong dollar. Where and how does that create opportunities for us as investors?
Yeah, so far the deglobalization trend has really benefited the US. So the fact that we were able to reopen the economy and get moving after the pandemic, much more quickly than the rest of the world, that's really driven a lot of our markets. And so the reason that we see a stronger dollar, right, and the reason that we're in a situation where we're even seeing these increases in inflation is because growth rates have come in well ahead of expectations. As I mentioned, we're still kind of seeing a slowing trend. We were 5% in 2022, 3.1% in GDP in 2023, and now we're seeing some numbers come in that are lower than that. But the growth picture is very strong for us. And so what we're concerned about is if the Fed does have to keep interest rates longer, how is that going to filter through the economy and impact markets? But if you think about those fundamentals and just being the beneficiary of a lot of the capital out there in the global markets, if we get to a situation where the Fed doesn't cut, and that causes volatility, as I mentioned many times in the presentation, that's going to be an opportunity for us, right? I think if we see a big pullback here, we're going to look to really adjust the mix and increase some of our equity exposure.
Thank you, Charles. Mike, the final question is going to be for you, and there's a lot of questions around fixed income and positioning. Is it time for us to start extending duration, or do we expect the yield curve to remain inverted?
Great, thank you. And I think that's a great question, and it's really something that we've been talking about quite a bit frequently. And especially when you do look at that curve inversion, where it's really paid to stay in these very short cash-like instruments versus venturing out on the curve where yields are lower and they have been more volatile. But one thing that comes up in these conversations is that there tends to be this focus on, when is that first rate cut going to occur, right? And a tendency to want to wait for it rather than to take action now. And when we think about the market, and we're more focused on, where we think rates will be 12 months from now and 24 months from now. And it's clear that the Fed, at some point is going to begin to normalize rates, and yields on the front end of the curve will come down. And when that happens, cash is going to underperform the longer parts of the market. And so for a cash investor, for a short-term cash investor, liquidity type portfolio where they might need the funds, it makes sense to stay really short and enjoy these yields. Or if there's a little bit of flexibility, move out to 1 year or 2 years where we have 5% yields again today. So it's a it's a nice opportunity to moderately extend for a short mandate. But then for somebody with a longer horizon, right, we think now is the time to take advantage of the move up in rates that we've been seeing, and the risk reward payoff seems a lot more favorable. So for example, if you have an intermediate taxable portfolio with 1 to 10 year bonds, maybe a mix of corporates and treasuries, it's going to yield about 5.5% today. It's going to have a duration of about 3.5%. So what does that mean? That means if rates move up about 100 basis points and we look out over the next 12 months, that portfolio is still going to have a positive return of about 2%. But if rates decline by about 50 basis points, when you combine your income plus whatever price appreciation you get, you could have a return of about 7%. So we like the market. We like the yields that we're seeing today. And if you have a longer horizon and it makes sense in terms of your overall asset allocation, by all means, it's a great time to start extending and taking advantage of the yields we're seeing in the market today.
Thank you, Mike. Thank you all for joining us today. A brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. A replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. Have a great day, everyone.